From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Monday, the 15th of November, 3 p.m. in London, 10 a.m. over in New York. We're 30 minutes into a relatively uneventful trading session for U.S. equities. From London, I'm Guy Johnson. Alix Steel, of course, over in New York. Welcome, everybody, to Bloomberg Markets. Alix, there's so much to talk about today. I was fascinated to hear the Treasury Secretary talking over the weekend, talking about the idea that inflation won't go away until the pandemic goes away. Here in Europe, that ain't happening.
Well, it's the same thing
here.
Day
after day, we're heading back to, we're heading towards lockdown light right now. The Irish are going to do it tonight. The Austrians have done it today. That is the new narrative that we're going to have to focus on.
Yeah, but it's the same thing here in the U.S., like where you have high booster rates. New York City just lowered the booster age to 18 and up. Anyone 18 and up can now get their booster. So clearly, it's about getting ahead of whatever winter weather and winter issues we're going to have with the flu and COVID. So how do the markets respond to that? Do not seem to care one bit. Are we past that COVID catalyst, basically? Andrew Sheets, though, I should point out, over at Morgan Stanley, pretty much downgraded the U.S. and is betting on Japan and Europe for next year. Maybe a relative outlier when it comes to U.S. equities, because U.S. equities are up by 0.2%, led by industrials, financials, utilities, and consumer communication services. So it's a mixed bag when it comes to that. A big part of their call is that you're going to see 10-year yield over 2%. You can see it having a nice meaty sell-off here after the Empire manufacturing data came in much better than estimated. We're now up by about 4 basis points. 1.6 is where we sit. We're seeing a lot of those forecasts come in, and as we're dealing with inflation with the pandemic overlay, we're getting some bullish calls on the dollar. UBS as well as HSBC seeing that. Euro dollar trading a teeny tiny bit heavy. And guys, something we're going to talk to you over the next few hours is what do you do with oil prices? There's still the debate in the market. The ADIPEC conference talking more bullishly about oil. President Biden still kind of between a rock and a hard place when it comes to how to lower those gasoline prices.
That was a very good penguin impression, by the way.
Thank you.
Couple of things worth talking about right now. There you go. There's the penguin impression. Couple of things that are worth focusing on right now. Boris Johnson, the British Prime Minister, is holding a press conference. He's talking about the COVID story. We've got a lot to talk about when it comes to COVID here in Europe, as I mentioned. There he is. The Governor of the Bank of England is also speaking as well, alongside a number of members of the MPC. The suggestion there, certainly the hint there, is that we're going to be seeing rates going up fairly soon. We'll keep a track on both of those two events as they're happening. Let's talk about what is happening stateside, though, in a little bit more detail. We need to cover some of the major stories. The president is going to be signing his infrastructure bill a little bit later on today. Anne-Marie Jourdain is in D.C. talking about that. His approval ratings, those starting to come down and come down fairly sharply or continue to come down. Emily Wilkins is watching President Biden's virtual meeting with China's Xi Jinping. That's going to take place a little bit later on as well. Akshat Rathi joining us to talk about the takeaways from COP26 in Glasgow, the deals and, more importantly, the compromises. So let's kick off in D.C. with Anne-Marie Jourdain. Anne-Marie, this is a huge day for the president. We've been pushing for this infrastructure bill for a very, very long time. He's going to sign it into law. 1.2 trillion sounds massive. Is it a Pyrrhic victory, though, with consumers as worried as they are about inflation?
Well, it's a great question, Guy. The president is certainly going to tout this as a victory today. The former administration could not get it done. It was a long-running joke in Washington that every week was infrastructure week. And finally, this administration was able to deliver what they call here the BIF, and he's going to be signing that bipartisan infrastructure agreement into law today. Now, your second part of the question is very interesting because what we are seeing in the polls that the president has a new low approval rating, 41%. And you need to look at when those phone calls were done for that polling. It was done after the hard infrastructure, which across the country is widely seen as a success. That calling of those polls was done after, but still did not help the president. And that brings me to your final point, and that is inflation. When you look at these polling figures, half of Americans, many of them independents, are saying that it's the administration's fault when it comes to inflation, and they are blaming the administration. So really, you're going to see the president, when he speaks today, not just talk about this hard infrastructure agreement, and also punt to the fact that Congress is back in session. He wants the second part of his agenda done, but also he is going to make the case on how it is going to bring down inflation. Now, potentially not immediate term, but maybe for the longer term.
Yeah, it's such a good point. Bloomberg's Emery Hardern joining us there. Some actually say that maybe all the trade issues are hurting the supply chain and boosting inflation as well. So speaking of that, Presidents Joe Biden and Xi Jinping are going to be holding a virtual summit later today, and the stakes are really high when it comes to the U.S.-China relationship in many different categories. Emily Wilkins of Bloomberg Government is looking at what we could expect. What is on the docket? What does success look like?
Well, Alex, the stakes might be very high, but the expectations are actually quite low. The White House is sort of downplaying what to expect out of this meeting, saying that really the core thing that President Biden needs to do is just keep that line of communication open between him and Chinese President Xi Jinping. And that's sort of the main thing here, as tensions between the U.S. and China are really at a very low point. I mean, when you consider everything going on with COVID-19, with Taiwan, with human rights abuses, the idea about having this type of communication is so that the U.S. and China can continue to really compete with each other and be competitive, but also work with each other and avoid any sort of major conflict that might really disrupt how the two nations interact. As far as talking things to discuss today, really a wide range of options, including, as you mentioned, trade. You know, the U.S. and China are still in that trade deal signed under the Trump administration, but according to Bloomberg reporting, China has not lived up to its end of the bargain in purchasing U.S. products at the rate they said that they would be. So that could potentially be part of the conversation today. Also, they could touch on some of those more sensitive issues. It's like Taiwan, human rights, COVID-19. It's expected to be about a 3-hour conversation that's going to start around 7:45 p.m. tonight in Washington time. And we're definitely going to be keeping a very close eye on what is said.
Absolutely. China playing into our next story as well in a very big way. Emily Wilkins of Bloomberg Government, thanks for the setup. What am I talking about? I'm talking about COP26, the talks wrapping up in Glasgow. Negotiators clinching a deal over the weekend that aims to reduce the use of coal and boost climate targets a little bit sooner. Crucially, rules for carbon markets have finally been established. Joining us now, Akshat Rathi, Bloomberg climate reporter who's just returned from Glasgow. Relative to expectations, what did we get?
So the expectations were quite high, and I think they were on purpose very high. And of course, we didn't meet those, but that's the nature of climate conferences. They set out a target to try and rewire the economy to move away from fossil fuels, to keep 1.5 degrees Celsius, which is the most ambitious target under the Paris Agreement. But what we did get was a little bit of a watered down target on coal because India and China at the very last moment intervened. 1.5 degrees Celsius, as COP President Alok Sharma put it, is still possible, but its pulse is weak, as he put it. And that means countries will have to come next year and set even more ambitious targets. From a business and investor perspective, however, things have changed. We spoke to a number of experts after COP26 as to what they think was the takeaway for business and investors. And for them, it was very clear. Despite the watered down language, the legalese around phase out or phase down, they said for them, it's very clear that the goal they have now is to try and move away from fossil fuels. They have technology on their as a backwind for them, and they want to maximize the opportunity that the technology offers to be able to lower the risk of climate impacts as they go forward. John Kerry, the former Secretary of State and the climate envoy for the U.S., put it really well. He said there was a time when governments were the ones leading on climate action, but now it's firmly businesses, because businesses realize that the future requires a stable marketplace.
All right, Akshat, thanks a lot. Really appreciate it. Great summary there. Bloomberg's Akshat Rathi joining us to point out coal prices in the U.S. highest in 12 years. Guy?
That's amazing, isn't it?
Yeah.
That's where we're going. We're talking about the phase down of coal, yet on the same day, what do coal prices do? It's a bit like the president coming back and saying, pump more oil. Let's talk about two critical events that are taking place right now in the UK, Alex. The first one is happening at 10 Downing Street. The other one is happening just down the road at the Palace of Westminster at a hearing with the Governor of the Bank of England. So let's start. There's Chris Whitty, the Chief Medical Officer in the UK. Boris Johnson has just been speaking, talking about the fact that the UK cannot be complacent. A new wave, he says, of COVID is affecting the UK's nearest neighbours. We're seeing Ireland returning potentially to work from home tomorrow. You've got a lockdown for the unvaccinated in Austria, Germany moving in that direction. This is the direction of travel in Europe. So that's the story here in the UK. We're lowering the age as well that people are available to get their next booster shot or their first booster shot. So that's happening at 10 Downing Street. A little further down the road in Westminster, Andrew Bailey, the Governor of the Bank of England, is answering questions. Catherine Mann is alongside him. She's speaking right now. Remember, she's come from finance into the Bank of England very recently. I do remember that, Matt, every time we talk to her. Basically, the Governor of the Bank of England, though, saying that every meeting is in play. Michael Saunders, who's also there, member of the Monetary Policy Committee, saying that without tighter policy, inflation will rise. The market is now expecting December as being the time that we're going to get that rate hike coming through. Unless, of course, Alex, the unreliable boyfriend strikes again.
Yeah, that's what I was saying. It's like a double whammy, unreliable boyfriend. And then you add in COVID, and you wonder if the U.S. is just 6 weeks behind Europe, as we've been in this entire pandemic. And if this conversation is going to be happening here, and we're just kind of overthinking then that we're coming out of this. So to that, strategists are making their assessments for 2022. Morgan Stanley, the latest. They want to avoid U.S. stocks and bonds. We're going to speak to Amy Silverman of RBC Capital Markets, how investors are positioned into the next year. This is Bloomberg.
The pandemic has been calling the shots for the economy and for inflation. And if we want to get inflation down, I think continuing to make progress against the pandemic is the most important thing we can do.
Treasury Secretary Janet Yellen on how to manage the U.S. inflation story going forward. She was speaking over the weekend on CBS's Face the Nation. The debate on price pressures continues in the markets. Remember, equities near record highs. Similar story over here in Europe. It's interesting that the U.S. has quite strong inflation. Europe, according to Christine Lagarde today, that's not a problem here. Certainly not in the medium term. Pretty good to looking at the rally we're seeing in equities.
Well, Guy, the question is, how do you play it, right? If you have inflation pressures, if you have this recovering economy, do you pick value or do you pick growth as a hedge for that? And that's really the question. It's really the tug of war you've seen in the market these last couple of months. And a lot of the outperformance has actually been in those tech companies. This idea that where else are you going to get your iPhones? Where else are you going to get your tech? There's only so many players in this market, so therefore they can pass those costs on. Another big part of this, I want to point out in this last month, this acceleration in the growth part, that a lot of that has to do with the EV boom. So that's going to be something to keep in mind. The other thing I want to talk about is just how large companies are, how many of them are trading above their 200-day moving average, because the larger the company, the more easily they can absorb those costs, the more easily you can actually say, well, hold on a second, this isn't actually hitting my bottom line as, say, a small cap. And that's really what's being reflected in the market here. Your S&P 500, 73% of those companies trading above their 200-day moving average. That gets smaller as the company gets smaller as well. The Russell 2000 down 50, or up, I should say, only 55%. Once again, the bigger the company, the easier it is to absorb those costs. But let's talk about volume really quickly, because as we start to get into the holidays, you're going to see volume taper off just a little bit. But put that into context, into the pre-pandemic era, volume is still extremely elevated. So the question is, how much of the holiday trading is really going to impact all of that?
Really good setup, and I do feel like we're counting down to the end of the year. How do you rejigger with that? Bloomberg's Kriti Gupta, thank you very much. As we were mentioning, Morgan Stanley is staying clear of U.S. stocks and bonds next year. They suggest that investors be, quote, overweight Europe and Japan, underweight U.S., be patient on emerging markets. Financials, a key overweight in 2021 for them, remains favored, and as does energy and EM, as well as Europe. They see the S&P 500 by 4,400 by the end of 2022. Well, joining us now, Amy Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist. So, Amy, Lori Calvasina over at your shop just upgraded to 50-50 for next year for the S&P, because this year the stocks just ran so hard. How are investors positioned to take advantage of the next 6 weeks and then set up into 2022?
Hey, Alex. Yeah, when we look into that, obviously another part of Lori's call that's interesting is kind of just the continuation of the value trade as well. When we look to the derivatives markets, I would say the one thing that's very clear is option markets are not worried. And that's becoming a larger and larger disconnect from the bond markets. You see that volatility in the bond markets, you're not seeing in the equity markets, and you're not seeing people hedge. And what I think is even more interesting than that is when you look at value versus tech, there's also no distinction there. So it's not like people are more worried about tech than they are about value. It's kind of fairly bullish all the way through, which is quite interesting in the face of the inflation risks that we see.
So, Amy, are they not hedging? Are investors not hedging because it's so expensive to hedge, or are they not hedging because they're not that concerned?
Yeah, it's a great question. And actually, the relative expensiveness of hedging right now is not that high. Guy, it's going to sound a little strange, but part of what's contributing to this bizarre dynamic we're seeing in options right now is continued retail call buying in names like Tesla, Amazon, GME. The reason I say that is, if you look to Bloomberg's MEMB, these are really heavyweights in an IWM or a QQQs. So if you continue to get bullish demand there, it ends up bleeding into the ETF levels. So, you see this over demand for calls, and you see the puts as relatively less expensive. So it's a little bit of both.
Okay, so where do you want to be buying then cheap puts?
Look, I think the risk right now, obviously, as rates rise, there's kind of still a period where equities continue to outperform. I think the risk is actually the pacing, right? If the Fed has somehow screwed up, if you heard Dudley's comments this morning and the pacing is off, then you can see these sharp swings of volatility. So we always think about the world in terms of tails. Where is the tail attractive right now? The tails are very attractive in both IWM and QQQs in terms of owning that tail if downside does occur. And then the other one that I like is retail XRT into the holiday season, which again has not been that expensive. You can really comfortably sell upside now with all these things at highs and fully fund those downside protection levels.
What do you make of what is, you brought it up at the beginning, what do you make of what is happening in equity volatility versus bond market volatility? Bond market volatility really starting to pick up. The market's all over the place. Equity markets not so much. Just talk to me about how you see that being resolved.
Yeah, not to sound like a harbinger, but unfortunately, when you look to the past, that tends to resolve itself by equities following bonds, if you actually kind of look at the correlations over the past. And so, that gives me a little bit of nervousness. And it's one of the reasons why I've been telling investors that when these tails to the downside look inexpensive and you have one part of the market saying something different than the other part, then, it's a time to kind of consider those hedges when they haven't become kind of overblown, because typically, the options market can react two ways. When things continue to go up, you can start to see demand for downside go up. And that has not happened right now.
So, Amy, are retail investors still as heavily involved in the market as they were, say, 12 months ago? And I ask that because I wonder if that changes the calculus of how we're used to thinking about like the next 6 weeks in the market.
Yeah, the short answer is yes. It's become really interesting because you always have to factor this in particular on a stock like Tesla or something like that. But and they only seem to like buying call options. It's kind of interesting. Like I don't know why there is that skew, but that is something that we've had to factor in, and that, as I mentioned before, is starting to bleed into your ETF levels because a Tesla is such a heavyweight, for instance, in XLY, and the same thing for a GameStop in IWM. So you have to factor that in, and then the other thing that is related to that is these upside momentum swings can go on for longer than you typically would have them because of the fact that it continues to exist.
What's the relationship with crypto and meme stocks right now?
But everything we talk about for inflation and the risks ahead, it is a good thing for crypto, right? If you think about, what people are going to look to hedge and kind of maybe trading out of a gold or your traditional hedges into crypto, it's a very similar cohort from, what I can tell, who is investing both in equity call options on these meme names as well as crypto. I think, when we talk to the head of risk strategies at Coinbase, Gustavo Miguel, one factor that he pointed out for next year, in the second half of next year, will be the merge. So essentially the change in protocol in Ethereum. That'll be a big catalyst to watch. And then near term is actually taxes. the fact that, people who've made a lot of money in crypto through yen are probably going to have a tax bill to watch out for.
In terms of, I guess what I'm also trying to understand is, as crypto does well, does that mean that the call buying in equities is well supported? If you remove one leg of the stool, does the other one become impacted? Because previously, if crypto fell out of bed, there was definitely an impact into some of these meme stocks. Crypto's doing relatively well at the moment. You've got this inflation narrative. Does that continue to support the meme stock buying, particularly on the call front?
I think on the retail side, I think that does make sense. If you're doing well, you're making money. Just bring it back to one person, right? You're a person who trades crypto. You're doing well. You have the ability to fund the retail call buying as well. I think that's part of it. But the larger story is there's also just more institutional adoption in crypto, and so I think it's kind of more difficult to suss that out. I will tell you, when we've looked at correlations in the past, there actually tends to be an inverse correlation in some of the meme stocks, like a GameStop and an AMC, compared to Bitcoin and Ethereum, which, I don't know how that holds up over longer periods of time because there just simply isn't that data yet, but we've actually seen a negative correlation there in the past.
We will find out. Amy, always a pleasure, always insightful, always interesting. Thank you very much indeed. Amy Silverman of RBC Capital Markets. A bit more coming through from Boris Johnson. The press conference continues, talking not only about what's happening with the COVID crisis that Europe is experiencing right now, talking about the fact that he doesn't see anything in the data calling for tougher measures. He's also talking about what is happening with Russia, talking about the fact that the UK stands behind Poland in what is happening on the borders. We'll continue to monitor this, but it looks like it's broadening out from simply just a COVID briefing right now, Alex.
All right, looking forward to hearing more from that. All right, still ahead, you got Tesla's retreat. Elon Musk is dangling the possibility of selling more Tesla shares. He basically trolls Senator Bernie Sanders on Twitter. It was amazing. More on that next. This is Bloomberg.
Tesla is falling. It's down by 4.5%, nearly 5% right now on the back of Musk versus Sanders. Dave Wilson taking a look at the numbers. What's going on?
Well, it's really a continuation of what you saw last week, Guy. I mean, Tesla shares down about 15.5%, biggest drop since March of last year. And so you now have these tweets over the weekend as far as, Senator Bernie Sanders and, okay, I'll just go ahead and sell some more stock. You want me to? Just say the word. That's, Musk kind of going on. And so that goes to show you that there's a potential for more.
All of these things go right at lowering costs for American families, and this bill is fully paid for. It's not going to add to inflationary pressures, quite the opposite, because we're going to pay for everything in this bill by raising taxes on big companies, large corporations, and the highest income Americans.
That was Brian Deese, White House top economic advisors, talking to the morning shows over the weekend about what this hard infrastructure bill is going to mean, and then also what that $2 trillion plus bill, or that $2 trillion bill, is. What's that going to mean if that's able to get through the House and then get to the Senate? Guy, it feels like the firm stance from the White House, this is not going to be inflationary. The other part of the coin is, if you're going to add like $2 trillion worth of money in two bills, how is that at some point not going to be inflationary in some aspects of the market?
Well, you saw what happened with the University of Michigan data on Friday, pushing sharply lower.
Yeah.
The consumer is clearly worried about inflation. You see it pretty much everywhere. Gas prices are obviously a major part of this. The president clearly needs to take action on that front to get that under control. Larry Summers has got a new op-ed. It's just coming out in the Washington Post. Let me read the quote from it. Excessive inflation and a sense that it was not being controlled helped elect Richard Nixon and Ronald Reagan and risks bringing Donald Trump back to power. This is the story for the administration right now. That's why I asked the question to Anne-Marie, talking about the fact, is this a Pyrrhic victory? Have we moved on already?
Oh, it really feels like yes. And also you can look at the market reaction to the hard infrastructure bill, and it was pretty non-existent. Maybe individual idiosyncratic sectors or stocks, but that was kind of it. Let's get more into this. Andy Blocker, Invesco head of U.S. Government Affairs, joins us now. Andy, Guy and I were just talking about the fact that the market moved on. Do we really need $2 trillion worth of stimulus? You have Biden's approval rating is also.
So I think you're having the right conversation, but let's take a step back. So President Biden campaigned on being able to work in a bipartisan manner to get things done for the American people. And so getting the bipartisan infrastructure bill, that's a big win for him. That's a start. But you're also talking about the fact that inflation is a huge issue. So even though they're like happy that he got this done, it's all good in the polls as far as favoring the bipartisan infrastructure bill. He still hasn't seen it in his numbers. He's only at 41%. That's because it's gas and groceries. That's what people are concerned about. They're not concerned about this, but he still needs to deliver on what he's promised.
What about the soft infrastructure side of things? Do we need that? Should he be spending a lot of time talking about it? Is it a big focus, do you think, for the administration as they try and find a way of getting those numbers to go up? Is that where they should be spending their time or elsewhere?
So I think you're onto something. I think first they're going to spend as much time on the bipartisan infrastructure bill. The signing ceremonies today is going to talk about that for some time. But he's also going to have to deliver on the Build Back Better plan. He's going to have to deliver on it because he promised it. If you look at his numbers, most of his numbers being down is because of Democrats leaving him. So he's like 15 to 20 points underwater from where he was at the beginning on Democrats and progressives. And so he needs to deal the Build Back Better there for them. But he also needs to deal with the inflation, and his toolbox is very short. He's going to have to hope this goes through its cycle so that comes back as well.
But do they care if gasoline prices still stay at $3.4 a gallon for the national average? Like, does it matter if we pass this human infrastructure bill if gas prices are just still too high?
Absolutely. I mean, that's what impacts people's daily lives. I mean, gas and groceries, like I said at the beginning. Now, for us, as on the economic side and trying to predict where the markets are, we're really looking at housing and we're looking at wages, and that's to determine whether it's long term or not. And so, but politically, he really needs a break with getting this bill done, getting the next bill done, as far as just fulfilling his promises. But then he needs the economy to kind of settle out, the supply chain to settle, so that our people aren't going to feel the pain most acutely.
How do the Republicans take advantage of this?
Well, I think the Republicans are doing exactly what they should be doing from a political stance. They're getting out of the way. They're saying, hey, look at what's in your pocketbook. Look at inflation. Pointing to the things that aren't going right because they're out of power. And whenever you're out of power, you want to focus on the things that aren't going well. I think there were some Republicans who did the right thing in their congressional districts to vote for the bipartisan infrastructure bill because otherwise they would have been in jeopardy. But going forward on this Democrat-only Build Back Better, it's just get out of the way, have the Democrats kind of work it out against each other, and that's going to be a messy process. Even though they've gotten some distance on it, it's going to be a long time before they actually get the Build Back Better done. I'm looking at the mid to end of December.
The other stuff that has to happen, right? We have to raise the debt ceiling. There has to be a budget. There's also the Xi Biden meeting, virtual summit later on tonight. And then there's also who's going to lead the Fed. Can President Biden walk and chew gum with all of these at the same time? Like, look at all of them, and which is going to be the most important?
Nothing to see here, nothing to do here in Washington, right? I think, look, he's going to have to, okay? And I think with the Fed situation, I think the most politically easy thing to do would be to renominate Powell because he has the votes for him. Republicans are going to vote for him. But he's going to get a lot of pressure from progressives. We'll hopefully find out maybe this week, maybe this next month. We don't know. But that's the first thing. The second thing, I think, is continue to show that he can execute as commander-in-chief and lead his party to get things done, and also be out there showing people, hey, he cares about the pain they're feeling right now with inflation.
In terms of the Xi meeting tonight, what are you expecting? What should we be looking for?
Well, I think the markets aren't really expecting much. What we do want, though, is we want a stabilization of the relationship. If you look back, Trump really passed the Rubicon on China. He took it to them on tariffs, and he changed the relationship to much more of an antagonistic relationship. And what we've been saying from the beginning is that no matter whether Trump was elected president or whether Biden became president, the general direction would not change. The method of dealing with them would change, but not the general direction. 73% last year, Pew Research had a negative view of China, 76% this year. So politically, Biden really can't give much over to the Chinese unless he gets a lot back. So look at this as the beginning of tamping down the rhetoric, looking for opportunities to work together going forward.
Do you think that the trade restrictions are in some part responsible for inflation and a labor shortage that we're seeing? Because there is a group in the market that does think that.
I think it's first supply chain, and I think also people know that, like, basically when you increase tariffs, it's like a tax increase. So it is inflationary. It does increase costs. So I think it's a combination. So to the extent that some of the sectors we can reduce the amount of tariffs in certain sectors, that would be good. Politically, he's not going to be able to get rid of the steel and aluminum tariffs, but he can get some other sectors which are impacting consumers.
Andy, we're going to leave it there. Thank you very much indeed for your time today, sir. Really appreciate it. Andy Blocker, Invesco Head of UK Government Affairs. You wonder whether China really cares about what is happening with US business right now and the inflation rate that it's experiencing and the problems that consumers are facing.
Highly doubt it.
Right now.
But who knows?
Yep, exactly. Got to focus on Taiwan. That's the story. That's what they're really worried about. What are we going to talk about next? Pressure rising in Washington. As we've just been talking about, gas prices are continuing to soar. Kevin Book, Clearview Energy Partners Managing Director and co-founder, is next. We'll talk about this subject. It's a big problem for the president. This is Bloomberg.
This is Bloomberg Markets. You are looking at a live shot of the principal room. Tune in to the Bloomberg New Economy Forum that's kicking off in Singapore tomorrow. Amazing guests all throughout the week. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Alix Steel. You got the Senate Majority Leader Chuck Schumer is urging President Biden to take steps to help lower gasoline prices in the U.S.
We need immediate relief at the gas pump, and the place to look is the Strategic Petroleum Reserve. So that's why I'm urging the administration to tap that reserve, get the prices down, and then we have to embark on a full-time campaign to get us away from carbon fuels altogether.
In the meantime, OPEC and its allies are not panicking at the prospect of the U.S. drawing down its strategic reserves. Many officials from the cartel and the world's biggest energy companies are meeting in Abu Dhabi this week.
That decision has been taken before, and that decision has been announced, and it's a normal, it has a normal cycle. The U.S. have been doing that for a very long time, and I think they'll continue doing that until 2025.
The ADIPEC conference in Abu Dhabi is one of the first major in-person events for the industry since the pandemic began. And in Abu Dhabi, Russia's deputy energy minister also is speaking and says he sees no shortage of oil in the market in the near future.
There is, of course, some hype in the market, but at the same time, looking forward, we have the seasonal drop in demand in winter. We have more and more oil coming from the OPEC Plus group, 400,000 barrels a month. Every month is being added. And coupled with a seasonal throw in demand and some more lockdowns which you're experiencing, we believe that there is no deficit at the moment. There will be surplus.
Sorokin said that the cost of renewable energy has come down, but that it's in large part due to low interest rates for such projects. And that's your First Word News. Guy, that feels like very strong no's coming from any member of OPEC Plus. No thanks. We're not going to release any more oil. It's up to you, President Biden.
It's amazing the pressure's not telling at the moment, isn't it? Sticking to the plan certainly seems to be the message coming out of ADIPEC and from OPEC more broadly, as you say. President Biden, as a result of this, Alex, exploring pretty much all of his options. Pressure mounting from every corner to bring gas prices down. Scott Sheffield, we talked to him a few days back. He's the Pioneer Natural Resources CEO and founder. He's not sure if the president is sort of pushing the right buttons right now. This is what he had to say to Alex and I last month on this very subject.
The president is realizing all the efforts when he came into office of stopping offshore leasing, stopping drilling on federal leases offshore, New Mexico, both in the Bakken, in the Powder River. It's starting to backfire some. But at the same time, I don't think they realize what's changed in the U.S. is our investors want cash back.
Scott Sheffield not mincing his words. Joining us now, Kevin Book, Clearview Energy Partners Managing Director and co-founder. What do you think the president needs to do?
Well, there's the school of thought, Guy, that doing nothing will be the right answer because in the end, the market sorts itself out. That's certainly the line that OPEC has taken. It's also the line that the EIA and the IEA have taken in their outlooks at the cyclical turn coming in winter. But having said that there's something that needs to be done, it's going to be very hard for any elected leader to do nothing. And so we still think that if there's a likely option, it's most likely to be a strategic petroleum reserve draw.
How quickly and how soon does that have to come to make a material difference?
Well, the announcement of the draw probably makes a difference in the market immediately. The expectation of it may already be pricing in. There's been a certain amount of jawboning going on even since August. Speculative long interest looked like it responded when Energy Secretary Jennifer Granholm mentioned a ban on oil exports. That was October 6th, and there's been a decline in long interest since then. I think if you look ahead, the real question is whether the SPR draw would be enough to tide prices over until the cyclical turn. And of course, then there's the possibility that the cyclical turn doesn't happen. What would you do next? But moving quickly, relatively soon, ahead of the holiday season, probably would be the right time frame, politically speaking, if not economically.
Kevin, the president is going to be speaking to Xi Jinping a little bit later on, the Chinese leader. He hasn't yet picked up the phone and spoken to the Crown Prince of Saudi Arabia. Hasn't happened yet. We've been talking to a number of people that suggest that if he were to do so and normalize relations, then the Saudis might be a little bit more pliant on the president's wishes to get energy prices down. Is this about politics? Is this about international relations more than anything else?
Well, there's always more than oil going on in oil markets, Guy, as you well know. And in this particular case, personal diplomacy probably could go a little further than it might otherwise. But there are constraints. The OPEC Plus deal is carefully architected. Deviating from the plan could create internal rifts. It wasn't so very long ago that we remember when the members of the group and the expanded membership of OPEC Plus weren't all marching in the same direction, March 2020. And so breaking the deal unilaterally because of a conversation with the president, probably not in anyone's interest, even the kingdom. But doing it on their own terms when they meet formally in December, maybe.
What I'm having a hard time understanding, Kevin, is the urgency behind it, whether it's coming from politicians or President Biden, just the rhetoric. I mean, I understand that this is going to hurt for certain individuals, but the national average is still $3.40 a gallon. Where is the real pain? Why is this such a pressing conversation right now?
You know, speed is always the issue. The price itself almost never is. To some degree, if you look at the disposable income share that's going to gasoline, it's well below where it was in the prior decade average and even a few years back. Disposable incomes are up a little because wallets have been padded by savings and stimulus. But tell that to the marginal voter or the marginal consumer. The urgency, again, may not be economic in nature, but more political. If you took a drubbing in Virginia, what would look like it was going to be a blue state for a while, a couple of Tuesdays ago, you're probably thinking this coming Tuesday about what you might want to do. So there are needs that are economic in nature, and I think you're very right to couch this in terms of history and comparables. But when something happens fast, it becomes an emotional issue. People buy gasoline before they use it, and they feel it in their wallet right away.
What happens if an SPR release doesn't work? What else is in the toolbox?
Well, the toolbox is actually pretty limited in terms of good ideas. The SPR is there's many different flavors of the SPR. There's 18 million barrels that Congress asked the Department of Energy to sell. They could go ahead and decide to do so earlier than maybe expected. That could happen, and then leave another 30 million barrels for non-emergency sales at the president's wish as he wanted to go forward. There are some downsides. Putting oil on the market, deterring the investment thesis for domestic producers who are slow to come back. The administration keeps talking about using the Federal Trade Commission to investigate market manipulation and price gouging. Past investigations have yielded very little. It's unlikely to produce much. Export bans could have some significant consequences, deterring production in the U.S. in the long run, and probably driving up global prices more than bringing them down. So the jawbone and the continued investment at the upstream, one aspect available to the president is regulatory leniency. That one becomes politically difficult from the left, showing the willingness to be flexible on fossil fuels. It's already happening. We were expecting a big report in federal lands leasing reform. Hasn't come out yet. But I don't think you can expect the president immediately post-Glasgow to turn his back on his green agenda.
Yeah, that's such a great point, because I feel like the timing in some ways could not have been worse for this energy crisis that we're experiencing. Vicki Hollub is the CEO of Occidental, and she was talking at ADIPEC also, and she said, and I'm quoting here, "If I was to make a call, I'd make a local call first. I wouldn't make a long-distance call." Why can't President Biden make a short-distance call?
Well, he absolutely can. In fact, it's even shorter distance. It's a local call over to the EPA or to the Bureau of Land Management. The problems are mostly the calls that he'll receive after he's done. Look, 80% of the growth in global demand was supplied by U.S. wells in the decade through 2019. The U.S. is a prolific production zone. As Scott Sheffield mentioned, investors are a little bit less enthusiastic about being that prolific. But at the margin, you can induce production by providing regulatory flexibility, by signaling ongoing flexibility. The problem is that those signals run counter to other signals that the Biden administration wants to send, not just to political constituents, but also to clean energy investment. And so it's not as easy as just making one call. There's going to be a lot of other calls that would have to follow it.
U.S. coal prices are at their highest level since 2009. Does that just tell you everything you need to know here about the situation? We're trying to pull every lever. We're trying to make sure the lights stay on. Oil production in the United States is limited for a number of different reasons. The U.S. energy infrastructure, the grid, is reaching for coal right now. What does that tell you about where we are?
Guy, it tells us a couple of very important things. The first is that plants that are still connected to the grid are going to run when the price is right. When the spark spread inverts and suddenly there's an incentive to burn coal, it's going to burn. So gas prices were incredibly low for so long, largely because gas came out as a consequence of oil production. Think of that as one of the consequences of drilling that maybe you don't want to stop immediately. And the second thing is that this is really the problem that industrial economies are facing. You can go to Glasgow and have best intentions, but when 24% of your power is coming from coal, you can't say that you're going to phase it out immediately, certainly not at a time when prices are high. Maybe at a lower gas price, more leniency in the market, there might be more room for politicians to navigate.
Kevin, we really appreciate it. Thank you so very much. Kevin Book, Clearview Energy Partners, Managing Director and co-founder. And Guy, I think that's a perfect point to make after COP26, because that's exactly what happened with India and China. They wanted the phase out for coal clause eliminated for this exact reason. And a lot of the smaller countries or the emerging market countries need money from the developed countries in order to do this. And without that, they have to have coal. That is at the crux of this entire problem.
Yep, if you want to phase out coal, you've got to pay for it. You look at South Africa, it's a classic case in point. Relies on coal heavily for employment. It relies on coal heavily for electricity. It needs to be paid for. The only positive I can take away from this, Alex, is that coal at least was mentioned. The fact that there was a conversation about phasing it out. It wasn't as good as we could have got, but at least it was talked about.
Yeah, the literal
That's a step in the right direction.
Literal word was mentioned.
Yeah, the fact that it was in the communique is a huge win.
All right.
This is Bloomberg.
It is time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Alix Steel. It is a deal that brings together a mattress seller and a fast food chicken chain. Sure, why not? Durational Capital Management has agreed to buy Casper Sleep for a price that's a 94% premium to its close on Friday. The stock had plunged 42% this year before today. Durational is the parent of the Bojangles restaurants. And signs of optimism about the aviation industry at the Dubai Air Show. Airbus CEO told Bloomberg TV he is starting to see signs of a recovery. Airbus landed a big order for 255 narrow-body jets with Wizz Air and 3 other discount carriers. And a new study finds that Pfizer and BioNTech COVID shots result in the strongest immune response. Researchers looked at 4 vaccines, and they found that people getting Sinopharm's inoculation may be particularly susceptible to a breakthrough coronavirus infection. And that is your business flash. Now, Guy, that study, though, didn't take into account Moderna. It was Astra, it was Pfizer, it was the Russian vaccines, Sputnik 5, and it was a Sinopharm. So I'm interested to see if that Moderna was in there, how that would shake out.
I don't know which one I'm going to be getting. I'm going to get mine very shortly. It's fascinating. I don't know whether we're doing mix and matching. It's going to be interesting to see whether or not you get, if you've had one, whether you get the Pfizer, whether you get the kind of the pickup as well. So that's what I'm really curious to find out, particularly at a time when cases are climbing pretty sharply here in Europe. It's going to be interesting to find out whether that dissuades Sharon Bell of Goldman Sachs on her call, a positive call on European equities. We'll find out next.